Welcome to the Deep Dive. Today, we're really going to tackle something big. All that conflicting advice in personal finance. The stuff that often makes you feel guilty or confused.
Yeah, we're kind of aiming to cut right through that. You could say we're taking an axe to it.
Exactly. Our goal here is to give you a single data-driven framework, something actionable for building real wealth based entirely on, well, what the evidence actually shows works.
Right. We want to boil down the science of saving and investing into essentially 3 core words.
3 words.
Yeah. And these aren't about, complex market timing tricks or trying to pick the next hot stock. It's all about consistency, behavior.
So challenging that common wisdom that you need to be some kind of Wall Street analyst or track every single penny.
Precisely. This philosophy is rooted in just the sheer power of habit, relentless habit.
And to really bring that home, let's start with maybe the most shocking example from the sources, this story of the late grandfather who retired at 55.
Yeah, this story is something else. So this guy, he retires at 55, and financially, he's in a pretty enviable spot. He's getting $2,200 a month guaranteed from his pension and Social Security.
Okay, solid income.
And get this, basically 0 living costs. He lives with his mother. So that $2,200 was almost entirely disposable income.
Wow, that's an amazing starting point. And financial independence pretty much handed to him.
You'd think so.
Yeah.
But he had a severe gambling addiction. For 26 years, every single month, he walked to the local casino and gambled away that entire $2,200.
The whole amount, every month, for 26 years.
The whole thing. So when he passed away in 2019, despite decades of that guaranteed income stream, he had nothing left. No assets.
Wow. That's incredibly sad. But also, there's a powerful lesson buried in there, isn't there?
Absolutely. The most powerful lesson, maybe, because if that grandfather, who was so incredibly consistent with his bad habit...
Right, the consistency is key, even negatively.
If he'd just redirected half of that money, just half, say $1,100 a month, and invested it consistently into just a simple, diversified U.S. stock market fund, for those same 26 years...
What would have happened?
He would have died a millionaire.
A millionaire. Even with investing through the 2000s. The dot-com crash, the financial crisis, that whole lost decade.
Even through all of that, one of the worst decades for market returns, the sheer discipline of just continually buying month after month, it completely overwhelmed the bad market timing. It canceled out the crashes.
That's astonishing. It really highlights that consistency is more powerful than trying to be clever, doesn't it?
It really does. And that is the core idea we're diving into today. It's summed up as just keep buying.
Yeah.
JKB.
JB. Okay.
Now, technically, the strategy is called dollar cost averaging, DCA. Most people might have heard of that. It's the mechanical act of buying regularly.
Right, investing the same amount periodically.
Exactly. But JKB adds the crucial layer. It's the how and the why. It's the psychological fuel you need to actually stick with DCA. Through the scary market drops, through the times when everyone else is panicking, and even through the euphoric highs when you might be tempted to stop.
So it's about making that investment habit as automatic, as fundamental as, say, paying your rent or mortgage.
Precisely. And the sources really emphasize why this JKD approach is, frankly, easier today than it has ever been before.
How so?
Well, think back to the 1990s. If you wanted to do DCA back then, it was expensive. A single trade, buying some stock, could easily cost you $8, maybe more.
Right, I remember those days. If you were investing, say, $100 a month, that $8 fee is a huge chunk of your investment gone right off the bat.
A massive chunk. It really ate into your returns, especially for smaller investors. It was a significant barrier.
Okay, so what's changed?
Pretty much everything, thankfully. Now you've got zero commission trading on major platforms. That's huge. Then there's fractional shares.
Ah, right. Meaning you don't need like $3,000 just to buy one share of Amazon or whatever. You can buy $50 worth.
Exactly. You can buy it based on the dollar amount you want to invest, not the share price. And finally, you have incredibly cheap, incredibly diversified index funds and ETFs readily available. Those old barriers, they're just gone.
So the whole system is basically set up now to reward the person who just commits to buying regularly, consistently, regardless of what the market headlines are screaming that day?
That's the essence of it. The friction has been removed.
Okay. So our mission today, then, using the data and evidence from these sources, is to really unpack this JKB philosophy and try to answer some of those tough questions people always grapple with.
Yeah, like when should you actually stop worrying so much about saving every penny? When does focusing on investing make more sense?
And things like debt, is it always bad? Or when could it actually be justifiable, maybe even helpful?
Right. And even retirement. Maybe you don't need to save quite as much as some of the scary headlines suggest. We'll look at the data on that too.
Hmm.
Okay, so the first big question we need to tackle is where you should actually focus your limited time and energy. You can't optimize everything at once, right?
Right. There's saving more, earning more, investing smarter. Where's the biggest bang for your buck, especially early on?
Exactly. And the guiding principle here, and look, it's framed a bit provocatively in the source material, is that saving is primarily for the poor and investing is primarily for the rich.
Whoa, okay, that sounds harsh. Poor and rich. We need to unpack that phrasing, don't we? Because I can see how someone struggling might hear that and feel, well, dismissed.
Absolutely fair point. And it's crucial to clarify, we are not using poor and rich in terms of character or effort or even current income necessarily. It's purely relative to your accumulated wealth, your assets.
Okay, relative to assets. Why frame it that way then?
Because it forces you to think about leverage. Where does applying your finite attention, your brain power, yield the biggest dollar return for you right now? Your focus needs to be where the leverage is greatest.
Got it. So it's about efficiency of effort. Let's make this concrete with that example of the recent college grad.
Perfect example.
Yeah.
So imagine a 23-year-old. Maybe they've managed to scrape together their first $1,000 and put it into a retirement account. Awesome start.
Yeah, great first step.
But then they spend hours, maybe hundreds of hours over the year, agonizing over the perfect asset allocation for that $1,000. Should it be 15% bonds?
Right.
20%. Are emerging markets represented properly? They're deep in the weeds on optimization.
Okay, I can picture that person trying to do everything right.
Meanwhile, let's say they live somewhere expensive, like San Francisco or New York, and maybe on a Friday night they go out with friends or colleagues, dinner, a couple of drinks, maybe an Uber home. Pretty standard stuff.
Sure.
And that night out easily costs them, say, $100, maybe more.
Okay, so where's the disconnect?
Here's the math. That $1,000 portfolio, let's be generous and assume it earns a fantastic 10% return over the entire year. How much growth is that?
$100.
$100. Over 12 months. That single night out, that $100 expense.
Wiped out the entire potential investment gain for the year.
Instantly. So at this stage, their potential savings, the new money they could potentially add, maybe $5,000 or $10,000 over the year, if they're disciplined, that number dwarfs the potential investment growth on their small starting capital.
Right. The $100 growth is tiny compared to the thousands they could potentially save.
Exactly. So spending hundreds of hours trying to squeeze an extra 0.5% return out of that $1,000 is, well, it's a colossal waste of time and energy. The leverage is entirely on the saving side. Discipline in saving, finding ways to save more, that trumps investment strategy completely at this stage.
Okay, that makes perfect sense. Now, let's contrast that with the other end of the spectrum. Someone who's been at it for a while, maybe has $10 million in invested assets.
For them, the situation is flipped entirely. Completely different ballgame.
So,
Let's say the market has a pretty standard correction. Drops 10%. For the person with $10 million, what just happened?
they just lost $1 million. On paper, at least.
$1 million. Now think about their savings. Even if they have a high income and save aggressively, maybe they save $200,000 a year. That's fantastic saving.
Yeah, that's a lot.
But how does that $200,000 annual saving compare to the $1 million portfolio drop they just experienced?
It's way smaller. It would take them 5 years of perfect saving just to make back that 10% drop.
Precisely. So for this person, where is the leverage? Where should they be spending their time and attention?
Clearly on the investment side. Managing risk, tax efficiency, maybe refining their allocation. The portfolio itself is the big giver now.
That's exactly right. Their focus must shift to the details of the portfolio because the dollar impact of investment fluctuations vastly outweighs their savings contributions.
So this leads to an actionable way for listeners to figure out where they should be focusing right now.
Yes. It's a simple comparison. You need to look at two numbers.
Okay.
Number one, your expected annual savings in dollar terms. How much new money do you realistically plan to save and invest over the next year?
Got it. Expected savings. Number 2.
Number two, your expected annual investment growth, again in dollar terms. How do you figure that out? Take your current total portfolio value, multiply it by a reasonable, maybe slightly conservative expected annual return, say 8% or maybe 10% if you're mostly in stocks.
Okay, so say I have $50,000 invested and I expect an 8% return. That's $4,000 in expected growth.
Right. Now, you compare that $4,000 expected growth to your expected annual savings. Let's say you plan to save $10,000 this year.
Okay, so $10,000 savings versus $4,000 growth.
In that case, your expected savings number, $10, is higher than your expected investment growth, 4K. So where should your primary focus be?
On saving more, increasing income, cutting expenses where possible, getting that savings number up.
Exactly. Now flip it. Say you have $200,000 invested. At 8%, that's $16,000 expected growth, and maybe you're still saving $10,000 a year.
Now growth, 16K, is higher than savings, $10.
Right. So now your focus needs to start shifting more towards optimizing that $200,000 portfolio, understanding risk, allocation fees, taxes. The investment side has more leverage.
And if the numbers are close, say $10,000 savings and $10,000 growth.
Then you focus on both. You're that transition point where both saving discipline and investment strategy are critically important.
That's a really clear framework, and it highlights how your focus naturally shifts over time, doesn't it?
It absolutely does. The sources show this visually over, say, a 30-year working life.
Yeah.
In the first decade or so, the overwhelming majority of your wealth accumulation comes directly from your savings contributions, the new money you put in.
Makes sense. The portfolio is small, so growth is small in dollar terms.
But as you get towards the later stages, maybe your last decade before retirement, compounding has really worked its magic. The portfolio is much larger. And by then, something like 70%, maybe even more, of your total wealth growth in those later years is coming from the investment gains themselves, not your ongoing contributions.
Wow. So the engine shifts from being primarily fueled by savings to being primarily fueled by the investments working for you.
That's the magic of compounding in action. Understanding where you are on that save-invest continuum today tells you where to point your energy for maximum effect. That's really step one.
Okay, so when we talk about saving, especially early on, you immediately run into those common rules of thumb, right? Like save 20% of your income, or you need 1 times your salary saved by age 30. They sound specific and helpful.
But the sources argue they're actually pretty flawed, maybe even unhelpful.
Why flawed? They seem like reasonable targets.
The core issue is they assume things are static. They assume your income is stable, your expenses are stable, your ability to save is stable. But is life ever really like that?
No, definitely not. Things change constantly. Job changes, moving cities, unexpected expenses, kids.
Exactly. Academic research backs this up. Income and savings ability are rarely static for long. Life happens, the environment changes, and your finances need to be able to adapt to that changing environment.
Okay, so rigidly sticking to a fixed percentage rule might actually cause problems if your circumstances change.
It can cause a lot of stress. Imagine you're diligently saving 20%. Then you have to move to a much higher cost of living area for a job, or you have unexpected medical bills. Suddenly, that 20% target might feel impossible. You feel like you're failing.
Right. It adds pressure when you're already dealing with change.
The sources use this really neat biological analogy, phenotypic plasticity.
Phenotypic plasticity. Okay, break that down.
Think about the Dolly Varden char. It's a type of salmon fish found in Alaskan streams.
Okay, a fish.
When the big salmon runs happen, there's suddenly a massive abundance of food salmon eggs. What did Dolly Varden char do? They gorge themselves. And interestingly, their actual digestive organs physically expand to allow them to process more food, to maximize energy intake while the bounty lasts.
Wow, their bodies adapt to the abundance.
But then, when the salmon run ends and food becomes scarce again, what happens? Their digestive tracts shrink back down. They adapt to conserve energy during the lean times. That physical adaptation to the changing environment, that's phenotypic plasticity.
Okay, cool analogy. So how does that apply to my bank account? I can't exactly shrink my stomach when my income drops.
No, but your financial habits need that same flexibility. If you're rigidly stuck on, I must save 20% when your environment changes, maybe income drops or expenses spike, you're fighting reality. You're creating stress.
So the advice should be more adaptable.
Exactly. The sources argue the best advice, though it sounds softer, is simply save what you can.
Save what you can. That sounds less stressful, definitely, but maybe less ambitious.
Maybe less ambitious on paper, but psychologically, it's far more resilient. Think about it. Money has been the #1 source of stress for Americans consistently since, like, 2007, according to the American Psychological Association.
Yeah, financial stress is huge.
So, removing an arbitrary, potentially unachievable fixed target, save 20%, and replacing it with an adaptive goal, save what you realistically can right now, dramatically reduces that stress. And ironically, when you reduce the stress and guilt, the habit of saving often becomes easier to maintain over the long haul.
Okay, that makes sense psychologically. So how do you figure out what you can save without driving yourself crazy tracking every single coffee?
Good question. You need your number, right? Savings equals income minus spending. Income is usually the easy part. Spending. That's where people get bogged down,
Yeah, the idea of logging every transaction feels overwhelming.
and often unnecessary. The recommendation is to avoid that kind of data collection obsession. Focus on estimation. First, figure out your fixed predictable spending. Rent or mortgage, insurance payments, car loan, known subscriptions like Netflix or gym memberships. Add those up.
Okay, the easy stuff.
Then, estimate your variable spending. Don't track every grocery trip, but think, okay, I usually spend about $100 a week on groceries, so estimate $400 for the month. Do the same for gas, entertainment, etc. Be realistic, maybe slightly conservative.
So ballpark estimates for the variable stuff based on typical habits.
Right. Add your fixed costs and your estimated variable costs. Subtract that total from your monthly take-home income. What's left, that's roughly what you can save right now. It gives you a realistic benchmark without the neurosis of tracking every dime.
Okay, a practical way to get a handle on it. Now let's shift gears a bit. You mentioned cutting through bad advice. What about that perennial favorite? Stop buying lattes and you'll become a millionaire. The idea that cutting small expenses is the path to wealth.
Ah, yes. The sources call this, quite pointedly, the biggest lie in personal finance.
The biggest lie. That's strong. Why?
Because for a huge portion of the population, it's mathematically impossible and, frankly, condescending. The data backs this up powerfully. Let's look at the Consumer Expenditure Survey data, specifically for the bottom 40% of U.S. households by income.
Okay, what does that data show?
Let's take the lowest 20% group in 2019. Their average after-tax income was about $1,020 per month.
$1,020 a month. Okay, that's tight.
Now, look at their spending on just 4 basic necessities: food, healthcare, housing, and transportation. Their average monthly spending on just those 4 essentials, $1,947.
Wait, they earn $1,020 after taxes, but spend $1,947 just on necessities.
Correct. They're spending nearly double their take-home pay just to cover the absolute basics. They are consistently operating at a deficit on essentials alone.
So telling someone in that situation to cut back on lattes to save money is...
It's absurd. It's completely missing the reality.
Yeah.
They would literally have to cut their spending on housing, food, healthcare, or transportation in half just to break even, let alone save anything significant. That's just not realistic.
Yeah, that puts the latte factor in a very different light.
And this disparity is amplified by a basic economic principle: diminishing marginal utility. The sources call it the law of the stomach.
Law of the stomach. Okay.
Think about pizza. That first slice when you're hungry, amazing. Maximum satisfaction. The second slice, still pretty good. The third slice, less enjoyable. The satisfaction you get from each additional unit decreases.
Right. The more you have, the less valuable the next one is. How does that apply here?
It applies to spending. For someone with a very high income, the cost of that third slice of pizza or the third vacation home or the third luxury car represents a tiny fraction of their overall resources. Cutting it saves them proportionally little and doesn't impact their core needs.
But for someone with low income?
For them, every dollar is likely going toward high utility spending, the first slice stuff. Food, shelter, basic needs. Cutting back means cutting things that provide significant value and well-being. It's much harder, mathematically and psychologically.
And the income disparity data really highlights this, doesn't it?
Hugely. In 2019, the highest 20% of U.S. earners made about 14 times more after-tax income than the lowest 20%. 14 times more money.
Wow.
But did they spend 14 times more on necessities like food and housing? Not even close. They only spent about 3.3 times more on those basics.
So as income skyrockets, spending on necessities increases much, much slower.
Exactly, which means higher earners have a vastly larger pool of discretionary income left over. It is simply mathematically easier for them to save large amounts than it is for low-income households, regardless of discipline or desire.
This really explains why low-income families often feel trapped, doesn't it? It's not necessarily about not trying hard enough.
Not at all. There's solid empirical research, like studies looking at wealth allocation programs in places like Bangladesh. They found that giving people even a small amount of initial productive capital, enabling them to buy assets rather than just survive day to day, made a huge difference. It showed that the lack of initial wealth, The inability to get ahead of basic survival needs is often what keeps people in poverty, not a lack of talent or motivation.
So that whole narrative blaming the poor for buying, say, name brand detergent like Tide Pods instead of the generic.
It's incredibly condescending and ignores the fundamental math. It also ignores the aggressive, often unrealistic assumptions behind the skip the latte, become a millionaire story. To make that $5 daily saving turn into $1 million over 40 years, you typically need to assume something like a 12% annualized return, consistently, with no interruptions. That's optimistic, to say the least.
Yeah, much higher than standard long-term market assumptions. Okay, so if cutting expenses isn't the realistic path to wealth for most people, what is?
The real leverage, the focus, needs to be on growing your income, specifically leveraging your human capital.
Human capital, that's basically the value of your skills, your knowledge, your experience, your time. Wow.
Exactly. It's your potential to earn. And the key is to actively convert that human capital into financial capital, into money and investments.
Okay, so how do people actually do that? What are the main ways to convert human capital?
The sources outline about 5 main avenues. The most common is simply selling your time or expertise. That's your standard salary job or hourly work.
Right. Trading time for money.
Second, selling a specific skill or service. This can be more scalable. Think freelance writing, graphic design, consulting, plumbing, electrical work. You're paid for a specific output or project.
Okay, skill-based.
Third, teaching people. This is highly scalable, especially now. Think creating online courses, workshops, writing books. You build it once, potentially sell it many times.
Leverage through teaching. Makes sense?
Fourth, selling a product. Again, potentially very scalable, especially with digital products. Software, ebooks, templates, build once, sell infinitely. Physical products too, of course, but often with more overhead.
Building something to sell.
And finally, number 5, which is actually the most common path for building significant wealth historically, climbing the corporate ladder.
Really? More common than starting your own business.
Yes. We have this image of the 22-year-old tech founder, but the data shows the average age of a successful entrepreneur is actually closer to 40. Many self-made millionaires build their wealth over decades within established companies, often leveraging professional degrees.
So gaining experience, skills, and capital within a traditional career path is often the foundation.
It very often is. That experience, network, and capital gained are frequently what enables later entrepreneurial success. Don't dismiss the power of a long-term career trajectory.
But the ultimate goal across many of these paths seems to involve ownership in some form.
Ownership is key. That's the ultimate conversion of human capital into something that generates financial capital even when you're not actively working. The example used is Jerry Richardson.
The former NFL player.
Right. He made some money playing football, sure, but his real fortune didn't come from his playing salary. He used his initial platform and capital to buy Hardee's franchises. He became an owner. That eventually led to him owning the Carolina Panthers NFL team. His wealth came from ownership, leveraging his initial human capital into assets.
Okay, so focus on income, focus on converting human capital, aim for ownership. Now, once you are earning more, how do you handle spending without falling into that trap of guilt that so much financial advice seems to induce?
This is where the 2X rule comes in. It's a purely psychological trick, but apparently quite effective.
2X rule. How does it work?
Simple. Let's say you want to splurge on something non-essential. A fancy gadget, a weekend trip, those expensive shoes. Let's say it costs $500.
Okay.
To spend that $500 guilt-free, the rule says you must immediately do one of 2 things. Either invest an equal amount, $500, into an income-producing asset like your index fund, or donate an equal amount, $500, to a charity you care about.
Ah, I see. So you're matching the indulgence spending with productive spending or giving spending.
Exactly. It reframes the splurge. It's no longer just money disappearing. It's a transaction where you get your enjoyment, but you also simultaneously bolster your future financial self or contribute to a cause. It psychologically neutralizes the guilt for many people.
That's clever. It links the reward to a responsible action. Beyond the 2X rule, how should we think about spending choices?
Focus on maximizing fulfillment rather than just chasing fleeting happiness.
Fulfillment versus happiness, what's the distinction?
Happiness is often momentary. The pleasure of eating ice cream, watching a funny movie. Fulfillment is deeper, longer lasting, the sense of accomplishment after finishing a tough project, the satisfaction of mastering a skill, the feeling of purpose from helping others. Running a marathon might not be happy moment to moment, but it's deeply fulfilling for many.
Okay, aim for fulfillment. How do you use that as a filter for spending?
You can use frameworks like Daniel Pink's Drivers of Motivation, Autonomy, Mastery, and Purpose. Ask yourself, does this purchase enhance my autonomy? Give me more control over my time or work? Does it help me achieve mastery in something I care about? Better tools for a hobby or profession? Does it align with my sense of purpose?
So if that daily $5 latte genuinely helps you focus and enhances your occupational mastery by making you more productive at work,
Then maybe it is justified spending viewed through that lens. It's not just about the cost, but about the value it provides toward your deeper goals.
and this ties into making spending personal, right? Aligning it with who you are.
Absolutely. Research actually shows that spending money in ways that align with your personality profile, whether you're introverted or extroverted, conscientious or open to experience, leads to significantly higher life satisfaction, even more so than just total income alone.
So spending money in character makes you happier than just having more money to spend generically.
That seems to be the finding. Your spending should reflect and support who you are and what brings you fulfillment, not just follow someone else's rules or chase fleeting pleasures. Okay, so we've established that growing income is key. But as income grows, a new danger emerges: lifestyle creep.
Ah, yes, the tendency for expenses to rise to meet or exceed income, keeping up with the Joneses, or maybe just rewarding yourself a bit too much.
Exactly. And the historical cautionary tale here is legendary: the House of Vanderbilt.
Cornelius Commodore Vanderbilt amassed a staggering fortune in railroads and shipping back in the 19th century, worth something like $200 million back then.
Which would be the equivalent of maybe $5 billion or more in today's money. An almost unimaginable sum.
And what happened to it?
Within just a couple of generations, about 75 years after the Commodore's death, it was basically gone, squandered.
How?
Just runaway lifestyle creep on an epic scale. Building massive, multiple mansions they called cottages, extravagant parties, collecting art, yachts. There's even stories of things like smoking cigarettes wrapped in $100 bills. Just extreme, unsustainable consumption.
Wow. A $5 billion modern equivalent fortune vanished in 75 years due to lifestyle inflation. That's sobering.
It's the ultimate warning. So how do we, in our normal lives, avoid falling into a similar, albeit smaller scale, trap as our income grows?
Is there a rule of thumb?
There's a simple, practical rule suggested: save 50% of your future raises and bonuses.
50%. Okay, explain the logic.
The idea is it provides a balance. You get to enjoy half your income increase, now upgrade your lifestyle a bit, spend more, feel the reward of your hard work. But the other half goes directly towards boosting your savings and investments, accelerating your path to financial independence.
So it lets you enjoy the present while still prioritizing the future. And the data suggests that spending more than 50% of raises starts to push your retirement date further out.
That's what the modeling tends to show. Consistently spending significantly more than half of your income growth means your expenses are rising too fast relative to your savings, delaying the point at which your investments can cover your lifestyle.
Okay, 50% seems like a solid guideline for most people, but you mentioned earlier there's a sort of counterintuitive trap, especially for people who are already high savers.
Yes, this is interesting. Let's say someone is already incredibly disciplined, maybe saving 50% of their current income. They have a relatively low spending base compared to their earnings.
Okay, a super saver.
Now, they get a 10% raise. Because their spending base is already low, that 10% raise represents a much larger proportional increase relative to their actual expenses compared to someone who spends, say, 80% of their income.
Right. The raise is bigger compared to what they actually live on.
So for this super saver to keep their original aggressive retirement timeline on track, they actually need to save a larger percentage of that new raise. The models suggest maybe something closer to 74% of the raise needs to be saved by them.
Wow. So the better you are at saving initially, the more disciplined you need to be with future raises to maintain your trajectory. That seems backwards.
It does feel backwards, but it makes mathematical sense because the raise has a disproportionate impact on their low spending level. Lifestyle creep, even a small amount, hits their savings rate harder.
So the simple 50% rule is more of a robust guideline for the majority of people, maybe those saving in the more typical 10% to 25% range.
Exactly. For that broad middle group, the 50% rule works beautifully. It's easy to remember, psychologically balanced, and keeps them generally on track without needing complex calculations for every single raise.
Okay, good clarification. Let's pivot now to debt. It gets such a bad rap, often framed as inherently evil. But the sources here frame it differently, right? As a tool.
Yes. Fundamentally, debt is just a financial tool. Like a hammer, It can be used to build something great, or it can cause damage if misused. It's not inherently good or bad. It depends on the context and the purpose.
So when can debt be a useful tool? Sometimes even high-interest debt. You mentioned bet hedging.
Right. Bet hedging helps explain something economists call a borrower-saver puzzle.
The puzzle being,
Right.
why do some people carry high-interest debt, like on a credit card, even when they have enough money in savings to pay it off completely? It seems financially irrational.
It does seem irrational on the surface. You're paying, say, 18% interest on the debt while maybe earning 1% on your savings. Why not just use the savings to wipe out the debt?
Yeah, what?
The bet hedging explanation suggests they're doing it, perhaps subconsciously, to manage liquidity risk. They worry about what might happen in the future. What if they lose their job? What if they have a huge medical emergency?
Okay.
If they use all their savings to pay off the credit card, they have zero cash cushion left. And they might worry that if they hit hard times, they won't be able to qualify for new credit when they desperately need it.
So they're willing to pay the high interest cost now as a sort of insurance premium to guarantee they have access to liquid cash, their savings, and potentially maintain their creditworthiness for future borrowing if things go really wrong.
Exactly. They're paying a short-term cost, interest, to reduce a perceived long-term risk, lack of liquidity in a crisis. They're prioritizing keeping that cash cushion intact.
That's a fascinating perspective. And this logic can be seen in extreme forms too, right? Like that microfinance example from India.
Yeah, the story of Seema. She had about $55 in savings, a significant amount for her context. But she still took out a small $20 loan at an incredibly high interest rate, something like 15% per month.
15% a month. Why on earth would she do that when she had savings?
She essentially used the high-interest loan as a forced savings mechanism. The loan had a very strict, rapid repayment schedule. Making those mandatory loan payments forced her to budget tightly and prevented her from dipping into her $55 savings account for small, non-essential things.
So the loan payments acted like a commitment device to protect her core savings.
Precisely. For her, the high cost of the debt was less important than the behavioral benefit of preserving her lump sum savings, which was her true safety net against major shocks. The debt helped her manage her own spending impulses.
Wow. That really reframes debt. So based on this, when is debt generally justifiable?
It's justifiable in two main scenarios. First, when it reduces risk. Think about a fixed-rate mortgage that locks in your housing costs for 30 years, reducing the risk of rent increases. Or, as we just discussed, maintaining an emergency fund, which is like borrowing from your future self at 0% interest, reduces liquidity risk.
Okay, risk reduction. What's the second scenario?
When the debt is expected to generate a return greater than its cost. This is investment debt. Think student loans to increase earning potential, a loan to start a promising business, or buying a home that you expect to appreciate, though we'll get to home appreciation in a moment. You're borrowing to acquire an asset or skill that should pay back more than the interest cost.
Makes sense. But there's a big caveat here, isn't there? Especially regarding the type of debt.
A huge caveat. The research is pretty clear. Non-mortgage debt, specifically credit card debt, payday loans, even informal loans from family and friends, is consistently linked with negative outcomes. Higher stress levels, depression, even physical effects like higher blood pressure.
But mortgage debt doesn't seem to have the same negative psychological impact.
Generally, no. Because it's tied to a large stabilizing asset, your home, it feels different.
Right.
It's seen more as a long-term investment payment rather than a sign of financial distress. So while debt can be a tool, consumer debt needs to be handled with extreme caution due to its potential psychological toll.
Okay, let's talk about that big asset, the home. Buying a house is often seen as the cornerstone of the American dream and a great investment. Is it?
Well, great investment might be overselling it from a purely financial return perspective.
Really, everyone says real estate always goes up.
Famous last words. Robert Shiller, the Nobel laureate economist, did the historical analysis. He looked at U.S. housing prices from 1915 to 2015, adjusting for inflation. The average annual return over that century, just 0.6%.
0.6% per year after inflation. That's barely anything, less than inflation in many periods.
Exactly. Now, housing is much less volatile than the stock market, which is a plus. It doesn't jump around as much day to day. But if you're looking for high long-term growth, housing historically hasn't delivered it compared to equities.
So if the financial return is pretty mediocre, why does everyone still emphasize buying a home? Why do it?
Because the reasons are often non-financial, and those can be incredibly important. Stability for your family, putting down roots in a community, access to specific schools, the freedom to renovate and make it your own. These are huge quality of life factors.
Right, it's more than just numbers.
And crucially, the sources emphasize that for many households, particularly those with lower or moderate incomes, the home often becomes their primary vehicle for wealth accumulation. It can represent 75% or more of their total net worth.
Why is it so central for them?
Because it acts like a forced savings mechanism. Paying the mortgage principal each month slowly builds equity. It's illiquid, hard to tap into easily, which prevents impulsive spending. Over decades, that slow, steady equity buildup can become substantial, even if the price appreciation itself isn't spectacular.
Okay, so valid non-financial reasons, and it serves as a forced savings plan. For someone who does decide they want to buy, what are the key factors for when to buy?
Stability is number one. Personal and professional stability. Ideally, you should plan to stay in that home for at least 5 years, preferably 10 or more.
Why so long?
Transaction costs. Buying and selling houses is expensive. Agent commissions, closing costs, moving expenses. These can easily eat up 10% to 15% of the home's value when you combine the costs of buying and eventually selling. Staying put longer allows any appreciation to hopefully overcome those high costs.
Okay, long time horizon. What else financially?
You need to be able to realistically afford it. That generally means having a 20% down payment or at least a clear path to saving it relatively quickly to avoid private mortgage insurance, PMI. And critically, you need to keep your debt-to-income ratio, or DTI, in check.
DTI. Remind us what that is.
It's all your monthly debt payments, mortgage, student loans, car loans, credit card minimums divided by your gross pre-tax monthly income. Lenders generally want to see this below 43% to meet the qualified mortgage standard, though lower is always better.
Right. Don't stretch yourself too thin. What about the idea of buying a small starter home first and then trading up?
The advice in the sources is actually skip the starter home if you possibly can.
Skip it.
Right. Again, transaction costs. Buying a starter home now and then selling it in 5-7 years to buy your forever home means you pay those huge transaction costs twice. Thousands, maybe tens of thousands of dollars down the drain.
So it's often better to wait, rent for a bit longer, save more aggressively, and then buy the home you can see yourself living in for 10 plus years.
That's the argument. Waiting to bypass that first set of transaction costs can save you a significant amount of money in the long run. Buy the bigger, longer-term home when you're ready.
Okay, makes sense. So let's say someone is saving for that down payment, whether it's for their first home or that longer-term home. Where should they park that cash while they're saving? Does it depend on how far away the goal is?
Absolutely. The time horizon is the single most important factor here.
What if the goal is short-term? Say they plan to buy within the next year or two.
For that shorter time frame, cash is king. High-yield savings accounts, maybe money market funds. You absolutely need principal protection.
Why not something slightly higher yielding, like short-term bonds?
Because even relatively safe bonds can lose value. Treasury bonds have had periods where they've dropped 3% or more in a short time. Imagine you're just about to close on your house and your down payment fund suddenly drops by 3%. That could force you to delay the purchase or scramble for extra cash. Not worth the risk for a short-term goal. Keep it safe. Keep it liquid.
Okay, short-term, 2 years, big lifts. Cash. What about a longer-term down payment goal, say 5 years or more out?
Here, the risk actually flips. Holding cash for 5+ years becomes the riskier strategy.
Riskier? How wow? Cash is safe.
It's safe from volatility, yes, but it's not safe from inflation. Inflation steadily erodes the purchasing power of your cash.
Ah, right. The target home price is likely going up over those 5 years due to inflation and maybe market appreciation, but your cash savings aren't keeping pace.
Exactly. The sources simulated this. If you were saving, say, $60,000 for a down payment over 5 years purely in cash, historical inflation rates suggest that, on average, you'd actually need to save for an extra 7 months just to reach the same purchasing power you were aiming for initially. Inflation effectively pushes your goalpost further away.
So for that longer time frame, 5+ years, you actually need some investment growth to keep pace with or hopefully beat inflation.
Correct. For a long-term down payment goal, you'd likely want a balanced portfolio. Maybe a mix of stocks and bonds tilted more conservatively than your retirement funds, but still with some growth potential to combat inflation's drag.
Yeah.
Holding only cash for that long is too detrimental to your purchasing power.
Time horizon dictates the strategy. Makes perfect sense. Okay, the ultimate goal for many savers. Retirement. Let's nail down the math first. The famous 4% rule. What is it, and how does it help you find your target savings number?
The 4% rule is a guideline developed by financial planner Bill Bengen back in the 90s. He looked at historical market returns and inflation. He found that if you retired with a portfolio balance between stocks and bonds, say 50–75% stocks, you could withdraw 4% of the initial portfolio value in your first year of retirement.
Okay, withdraw 4% initially.
Then you adjust that dollar amount upwards each year for inflation. So if you withdrew $40,000 in year one and inflation was 3%, you'd withdraw $41,200 in year two.
Got it. Adjust the withdrawal for inflation.
Bingen found that following this strategy, historically, your money had a very high probability of lasting for at least 30 years, even through bad market periods.
So it's a safe withdrawal rate guideline. How does that translate into a savings target?
It gives us a simple calculation. If you can safely withdraw 4% per year, that means you need a portfolio that is 25 times your desired annual withdrawal amount. So it's 1.04 equals 25.
25 times your annual spending in retirement.
Well, specifically 25 times your annual excess spending.
Excess spending, what's that?
That's your total anticipated annual spending in retirement minus any guaranteed income sources you expect to have, like Social Security, pensions, or maybe rental income.
Ah, okay. So you only need your portfolio to cover the spending that isn't already covered by other reliable sources.
Exactly. Let's say you figure you'll need $60,000 a year total to live comfortably in retirement, but you anticipate getting $20,000 a year from Social Security. Your excess spending that the portfolio needs to cover is $40,000, $60K, $20K.
Okay, $40,000 excess spending.
So your retirement savings target, using the 4% rule, would be 25 times that $40,000.
25 by $40,000 is $1 million. So you need $1 million portfolio in this example.
That's the target the 4% rule suggests. And it's worth noting, this rule is generally considered quite conservative.
Conservative? How so?
One reason is that it assumes your spending increases every single year with inflation. But studies of actual retiree spending patterns often show the opposite. Spending tends to decline slightly in real terms, by maybe 1% per year on average, as people age and slow down their activities. The 4% rule doesn't account for that potential decline.
So the required nest egg might even be a bit smaller in reality if spending decreases. But the 4% rule 25x target is a solid, safe starting point.
A very solid starting point for the financial calculation. But the math is often the easy part of retirement planning.
What's the hard part?
The existential part. What are you actually going to do all day?
Ah, the non-financial side, the purpose, the identity.
Exactly. For many people, work provides much more than just a paycheck. It provides structure, social interaction, a sense of competence, and identity. When that disappears overnight at retirement, it can leave a huge void.
You hear stories about this, people who achieve financial independence early and then get bored.
Totally. Kevin O'Leary, Mr. Wonderful from Shark Tank, talks about retiring at 36 after selling his first company. He said he was bored out of his mind and quickly went back to starting new ventures.
And even within the FIRE movement, financial independence, retire early, some people reach their number, quit their jobs, and then find it's kind of lonely. Or they lose their sense of purpose.
Yeah, you hear accounts of people finding FIRE can be a lonely existence if they haven't figured out what they're retiring to. Many end up going back to work, maybe part-time, or starting passion projects, just to have that structure and engagement again.
So the real challenge isn't just saving enough money, it's figuring out how you'll spend your time and find meaning after work.
Precisely. Money solves the money problems. It doesn't automatically solve the identity, purpose, or social connection problems. You need a plan for those too. What are you retiring to, not just from?
All right, let's shift our focus fully onto the investment side of the just keep buying philosophy. We touched on human capital earlier, your ability to earn money through skills and time. How does investing relate directly to that?
Think of your human capital as your biggest asset when you're young. It's the present value of all your future potential earnings. But here's the thing. It's a dwindling asset.
Dwindling how? Because you have fewer working years ahead of you as you age.
Exactly. Every year that passes, the remaining value of your future earning potential decreases. Investing is the essential process of converting that dwindling human capital into a different kind of asset, financial capital, that can sustain itself and hopefully grow even after you stop working.
So investing is basically building a replacement for your paycheck.
That's a great way to put it. There's a calculation in the sources to illustrate this. Let's say you earn $50,000 a year and you expect to work for 40 years. What's the present value of that entire future income stream?
Meaning, what's that future income worth in today's dollars?
Right. Using a standard financial discount rate, say 3%, that $50,000 a year for 40 years has present value of about $1.2 million.
Wow. So my future ability to work is currently worth over $1 million, in a sense.
In that simplified example, yes. And the goal of investing is to build up $1.2 million in financial capital stocks, bonds, real estate, etc., that can then generate income through dividends, interest, appreciation, to replace the income your human capital used to provide. You're literally building a financial machine to take over from your working self.
Okay, so it's imperative to invest to build that replacement machine. What should we be putting into that machine? What kinds of assets should we be buying?
The JKB philosophy strongly emphasizes income-producing assets. Assets that generate cash flow, not just assets you hope someone else will pay more for later.
So focusing on things that pay dividends, interest, or rent, rather than purely speculative things.
Generally, yes. Speculation has its place, maybe, but the core of a long-term wealth-building strategy should be assets that work for you by generating ongoing income.
Let's run through some of the main categories of income-producing assets mentioned, starting with the most common one.
Stocks or equities. Ownership shares in companies. Historically, they offer the best long-term returns, maybe in the 8–10% annualized range, but they come with significant volatility, ups and downs.
Okay. Stocks. What else?
REITs, real estate investment trusts. These are companies that own and operate income-producing real estate shopping malls, apartment buildings, office towers, data centers.
So it's like owning real estate, but through a stock.
Pretty much. You get exposure to real estate cash flows, rents, without the hassles of being a landlord. REITs tend to offer slightly higher returns, maybe 10–12% historically, partly because they are legally required to pay out most, 90% plus, of their taxable income to shareholders as dividends.
Interesting. High dividend payouts. What about more niche assets? Farmland.
Farmland is mentioned as an interesting diversifier. Potential returns might be in the 7–9% range, coming from both land appreciation and crop yields, or rent paid by farmers.
Why farmland specifically?
Two key reasons. It tends to have a very low correlation with the stock market, meaning it often zigs when the stock market zags, which helps smooth portfolio returns. And second, it's historically been a very good hedge against inflation. Land and food prices tend to rise with general price levels.
Okay, a stable inflation hedge. What about higher risk, higher potential return options?
That brings us to things like small businesses and angel investing in startups. Here, the potential returns are very high, maybe 20–25%, or even more if you hit a home run.
But there's a big if there.
A massive if.
Yeah.
The data shows extreme skewness. Most angel investments fail completely. Only about 11% historically have generated a positive return at all. Success requires deep expertise, significant time commitment for due diligence, and the willingness to accept that most of your bets will likely go to zero. It's not for the faint of heart or the passive investor.
Definitely sounds like expert territory. What about royalties?
Royalties are another interesting category. This could be income streams from music rights, book publishing, patents, things like that. Returns can vary widely, maybe 5–20%.
What's the appeal of royalties?
They tend to be highly uncorrelated with the broader economy or stock market. A hit song from the 1970s will keep generating royalties, regardless of whether the economy is in a recession. They offer a potentially steady, uncorrelated income stream.
And there was a tip for evaluating these types of assets, the Lindy effect.
Right, the Lindy effect, sometimes called dollar age when applied to income streams. The basic idea is that for certain non-perishable things like technologies, ideas, or income-producing assets like songs, the longer they have already existed or survived, the longer their future life expectancy is likely to be.
So a song that's been consistently generating royalties for 50 years is statistically more likely to continue generating royalties for another 50 years than a brand new song is.
That's the Lindy logic, yes. Past endurance predicts future endurance. So when looking at royalty streams, favoring older, proven earners might be less risky than betting on something new, even if the recent income levels look similar. Proven longevity matters.
Okay, that's a useful mental model. Now, just as important as what to own is what not to own, according to this income-focused philosophy.
Crucially, yes. The JKB approach generally excludes assets that don't produce a reliable income stream. Their value depends entirely on perception, on the hope that the next person will pay more than you did.
So what falls into this category?
Things like gold, Most cryptocurrencies, fine art, collectible wine, they don't generate dividends, they don't charge rent, they don't earn interest, they just sit there. Their price is driven purely by sentiment and speculation about future demand.
The greater fool theory, hoping someone else will buy it from you for more.
Essentially. While these can have diversification benefits or specific use cases, they aren't core income-producing assets in the JKB framework. The focus is on assets that work for you by generating cash flow.
Okay, focus on income producers. Now, even within stocks, the sources make a strong case against picking individual stocks. Why? Isn't that how people get really rich?
Sometimes, yes.
Right.
But the argument against it is less about the potential upside and more about the high probability of failure and the emotional cost involved.
Emotional cost. Let's use that GameStop story as an example.
Perfect, yeah. The friend, Darren, he got caught up in the GameStop mania, bought in at $111 a share. For a few minutes, the stock soared. He was up maybe $9,000 on paper. Pure elation, right? He felt like a genius.
The thrill of victory.
But then, just as quickly, it reversed. The stock plummeted. He held on, hoping, praying it would bounce back. Eventually, he couldn't take it anymore and sold around $70. Lost $12,000 in about 2 hours.
Ouch. From elation to agony.
Exactly. That single, short experience encapsulated the entire emotional roller coaster. FOMO, fear of missing out, driving the initial buy, the intense joy of a quick gain, the gut-wrenching pain of the loss, the regret, the second-guessing. The amount of mental and emotional energy consumed by that one stock pick was enormous.
Even if he could afford the loss, the psychological wear and tear is significant.
Hugely significant. And besides the emotional toll, the actual odds of successfully picking individual stocks long-term are just terrible.
Worse than people think.
Much worse. Consider professional fund managers. These are smart people, full-time jobs, access to research, sophisticated tools. Yet, studies consistently show that about 75% of them fail to beat their simple market index benchmark over a 5-year period.
3/4 of the pros can't beat the average.
Over a reasonable time frame, yes. If the highly paid experts struggle so much, what chance does the average individual investor realistically have dabbling in it part-time with less information?
Not great odds, it sounds like.
And it gets worse. Other research looked at all individual stocks going back decades to 1926. It found that the entire net gain of the U.S. stock market over that long period was generated by just the best performing 4% of stocks.
Only 4%. So the other 96% of stocks, in aggregate, basically returned nothing or lost money compared to just holding treasury bills.
That's the finding. Wealth creation in stock picking is incredibly concentrated in just a tiny handful of massive winners, the Amazons, the Apples. Your job as a stock picker is to find those needles in a giant haystack while avoiding the thousands of duds. The odds are heavily stacked against you.
It sounds like playing the lottery almost.
It has similar characteristics, and this leads to what the source calls existential dread.
Existential dread from stock picking. How?
Because the feedback loop is so incredibly long and noisy. Let's say you pick a stock and it goes up over the next year. Was it because you were smart, or were you just lucky? Did the company succeed for the reasons in your original thesis or for totally unrelated reasons?
Right. It's really hard to know if your success was skill or just random chance.
Exactly. It takes years, maybe even decades of consistent outperformance to have any real confidence that you possess genuine stock picking skill rather than just having caught a lucky wave. And most people won't beat the market anyway. So why, the argument goes, would you expend enormous mental energy, stress, and time playing a game where the odds are against you, and you can't even reliably prove if you're actually good at it?
When the alternative is just buying a simple diversified index fund that guarantees you the market average return with minimal effort and stress.
Precisely. Accept the average, focus your energy elsewhere, like earning more, and just keep buying the index. That's the core investment message.
Okay, so we're buying diversified, low-cost index funds or similar income-producing assets, and we're doing it consistently, JKB. Now, how do we handle the timing of those buys? Especially if we have a lump sum to invest, say from an inheritance or a bonus. Do we dump it all in at once or ease in?
This brings us to the strategy principle. Buy quickly, sell slowly.
Buy quickly. Why quickly?
Because, on average, markets tend to go up over time. That's driven by economic growth, productivity gains, population increases. So, logic dictates that the longer you wait to invest, the higher the price you're likely to pay. Delay is costly, on average.
So the data should show that investing a lump sum immediately, let's call that buy now, generally beats spreading it out over time, which is dollar cost averaging or average in.
That's exactly what the historical data shows. Comparing Investing a lump sum all at once, buy now, versus averaging it in over, say, 12 months, average in, buy now wins about 76% of the time.
3/4 of the time, just getting the money in pays off better.
And not just wins, but wins by a decent margin. On average, the buy now strategy leads to about 4% higher returns annually compared to the average in strategy over those periods.
So mathematically, buy now seems clearly superior. Why does anyone even consider average in DCA for a lump sum then?
Psychology, purely psychology. DCA feels safer to many people because the worst feeling in investing is putting all your money in right at the very peak of the market, just before a crash. Buy now maximizes the risk of that happening, though peaks are historically rare. Averaging in smooths out the purchase price. You won't buy everything at the absolute bottom, but you also guarantee you won't buy everything at the absolute top. It minimizes potential regret.
So DCA average in only actually outperforms buy now in those specific scenarios where you happen to invest the lump sum right before a significant market downturn.
Correct. Since market peaks are infrequent compared to periods of flat or rising markets, buy now wins most of the time. But DCA provides psychological comfort, which is valuable. It helps people overcome the inertia and fear of investing a large sum, ensuring the money actually gets into the market, even if slightly less optimally from a pure return standpoint.
So the JKB philosophy might lean towards buy now if you can stomach the psychological risk, but accepts average in as a perfectly valid way to get the money invested consistently if it helps you sleep at night.
That's a good summary. Getting the money invested is paramount. How exactly you do it with a lump sum is secondary, though statistically, sooner is better.
Okay. What about the other common timing temptation? Not averaging in, but actively waiting for a crash. Holding cash on the sidelines, hoping to buy the dip.
Yeah, the myth of timing the dip. This is where many investors get into trouble. The analysis on this is pretty damning.
How so?
The sources describe a simulation that assumes you have perfect foresight, godlike timing ability. You know exactly when the absolute bottom of every market crash will occur.
Okay, the best possible scenario for a dip buyer.
Right. Even with this perfect knowledge, the strategy of holding cash and only buying at the exact bottom consistently underperforms a simple, standard DCA strategy. Just investing regularly every month, regardless of market level.
Wait, even with perfect timing, buying the dip loses to just regular investing? How is that possible?
Because to buy the dip, you have to be holding cash while the market is going up most of the time, waiting for that infrequent crash. All that time, your cash is sitting on the sidelines. It's missing out on the market's general upward trend in dividends. The cost of being out of the market waiting for the dip outweighs the benefit of buying at the perfect bottom.
So the analysis showed this held true over long periods.
Yes. Over 70% of the 40-year periods analyzed, the perfect dip buying strategy resulted in less wealth than just investing the same amount automatically every single month.
Wow, that really demolishes the idea of waiting for a crash.
It really does. The clear takeaway is invest as soon as you have the money and as often as you can, like with every paycheck. Time in the market is far more important and far more achievable than trying to time the market. Just keep buying.
Okay, strategy is consistency, get money in quickly. But we have to acknowledge a huge factor we don't control. Luck, or what the finance world calls sequence of returns risk.
Absolutely critical point. Your ultimate investment outcome depends heavily on when you are investing. The specific sequence of market returns you experience during your accumulation and withdrawal phases plays a massive role, and it's largely out of your hands. It's luck of the draw.
The sources use a great analogy from the writing world here, Stephen King and his pseudonym.
Right, Stephen King, hugely famous author. Early in his career, he published some books under the pseudonym Richard Bachman, partly to see if they could succeed without his famous name attached.
Okay.
One of those Bachman books, Thinner, was selling okay, maybe moved 28,000 copies, respectable for an unknown author. But then the secret got out. It was revealed that Richard Bachman was actually Stephen King.
And what happened to sales?
They exploded instantly. The exact same book, now under King's name, sold 3 million copies.
Wow, so the quality of the book didn't change, but the luck of the author's famous name made all the difference in the outcome.
Precisely. Fame, brand, existing platform, you could call it luck in that context, determined the result far more than the inherent quality of the product alone.
And there's a direct parallel to market returns.
A very direct parallel. Consider two hypothetical investors. Investor A is incredibly skilled. They consistently beat the market index by 5% every single year. But Unlucky for them, they did this during a period of generally low market returns, say 1960 to 1980.
Okay, great skill, bad market timing, luck.
Now, investor B is a terrible investor. They consistently underperform the market by 5% every year. But lucky for them, they were investing during a roaring bull market period, say 1980 to 2000, when overall returns were extremely high.
Bad skill, great market timing, luck. Who ends up with more money?
Investor B, the terrible investor with good timing luck, ends up with significantly more money than investor A, the skilled investor with bad timing luck.
That's kind of depressing, actually. It suggests our individual skill matters less than just being born at the right time to catch a good market wave.
It highlights the huge role that the market environment plays. The sequence of returns you happen to live through is arguably the single biggest determinant of your final portfolio value. It's a factor you cannot control.
So, if luck is such a dominant factor, what can we do? How do we mitigate the impact of bad luck?
You double down on the things you can control.
Which are?
You control. 1, how much you save. Your savings rate is directly under your control. 2, your asset allocation. Choosing broadly diversified, low-cost assets increases your odds of capturing whatever market returns are available. 3, the consistency and frequency of your investment, the just keep buying principle itself. Sticking to the plan regardless of market conditions. These are your levers against the randomness of luck.
Focus on your own actions. Save diligently, invest wisely, diversified, low cost, be consistent. Okay. Now, part of being consistent means dealing with the inevitable ups and downs, volatility.
Volatility. It's not a bug, it's a feature.
Okay.
Or maybe better put, it's the price of admission you have to pay to earn the historically excellent long-term returns offered by assets like stocks.
Price of admission, meaning you don't get the high potential returns without accepting the bumps along the way.
Exactly. You have to be willing to tolerate the drawdowns. And they happen frequently. Looking at the S&P 500 since 1950, the average maximum drop within any given calendar year, the peak-to-trough decline is almost 14%.
An average drop of 14% sometime during the year, every year, that's significant.
It is. And some years are much worse, obviously. But you have to expect and accept regular double-digit declines as just part of the normal process of investing in stocks. If you can't handle that emotionally, you'll likely make behavioral mistakes.
Like panic selling during a drop.
That's the big one. Or just getting scared and trying to avoid the drops altogether.
Does trying to avoid drawdowns work?
It's financially disastrous. There's a simulation mentioned that looked at what happens if you try to sidestep even relatively small drawdowns, say getting out of the market whenever it drops by 5% or more, and only getting back in when things stabilize.
Okay, trying to dodge the dips. What was the result?
Compared to a simple buy and hold strategy, the market timing strategy aimed at avoiding 5% drawdowns resulted in 90% less wealth over the long term.
90% less. Why such a huge difference?
Because you inevitably spend too much time out of the market. Market timing requires 2 correct decisions: when to get out and when to get back in. Most people fail at both, especially the getting back in part. They miss the sharp recovery rallies that often follow declines. Trying to avoid the downside means you almost always miss out on significant portions of the upside. You must accept the downside risk to earn the long-term upside potential.
Okay, accept volatility, stay invested. But what about those really big, scary crashes? The 2008 crisis, the COVID crash in March 2020. Panic is everywhere. Fear is palpable. How do you psychologically manage to keep buying then when every instinct screams sell or wait?
This is where the JKB mindset becomes absolutely crucial. And sometimes perspective comes from unexpected places. The sources share this wonderful little story, the flower guy anecdote.
The flower guy, tell me about it.
This was during the absolute depths of the COVID crash in March 2020. The market was in free fall, down over 30% in weeks. Fear was rampant. Headlines were apocalyptic. The author goes to the grocery store, feeling the weight of the financial panic.
Yeah, I remember that feeling. Uncertainty everywhere.
And inside the store, amidst all this chaos, he sees an employee, just calmly, methodically, arranging bouquets of flowers in the floral section, completely absorbed in his task, making things look nice.
Just doing his job, focused on the flowers while the world felt like it was ending outside.
Exactly. And it was this profound moment of disconnect, the macro-level financial panic hitting this micro-level human normalcy. The author thought, if the world is truly ending, why is this guy still arranging flowers? It provided this jolt of perspective. Life goes on. This panic too shall pass. The world isn't actually ending, even if the stock market feels like it is.
That's a great image, a moment of calm perspective amidst the storm. Does that anecdote offer a practical takeaway for investors facing a crash?
I think the takeaway is twofold. First, trust the data. History shows that market crashes, while scary, have always been followed by recoveries. And statistically, the best buying opportunities occur during these periods of maximum pessimism.
What does the data say about buying during crashes?
The data is incredibly encouraging. Historically, when U.S. stocks have been down 30% or more from their peak, buying then has typically led to annualized returns of over 10% during the subsequent recovery period.
Okay, buying into steep declines pays off. What if it's even worse, like down 50%?
If the market is down 50% or more, which is rare, think 2008 or 9, the subsequent annualized returns from buying at those levels have often exceeded 25% per year during the recovery. Crisis creates opportunity. The data provides that rational anchor.
So lean on the data. What was the second takeaway from the flower guy?
It's behavioral. Focusing on your own routine, your own controllable actions like the flower guy focusing on his task, or you making your scheduled monthly investment deposit helps you regain a sense of control in an uncontrollable situation. It grounds you. Sticking to your JKB plan, mechanically buying when the market is down, is an act of discipline. It's an act of defiance against the prevailing panic. It's how you turn fear into future wealth.
Okay, we've covered buying consistently, handling volatility, focusing on income-producing assets. Now, the flip side of the buy quickly mantra was sell slowly. When should we actually consider selling our investments?
The philosophy is definitely biased towards holding long-term, but selling is sometimes necessary. Sources identify 3 main acceptable reasons to sell.
Reason number 1.
Rebalancing your portfolio. This isn't about timing the market or chasing returns. It's purely about managing risk.
How does rebalancing manage risk?
Let's say you start with a target allocation, maybe 60% stocks and 40% bonds. Over time, because stocks generally grow faster than bonds, your portfolio will naturally drift. If you don't rebalance, after 10, 20, or 30 years, that 60-40 portfolio might become 75% stocks, 85%, maybe even 95% stocks.
So it becomes much riskier than you originally intended.
Much riskier. Rebalancing, typically done maybe once a year, forces you to sell some of the assets that have done well, the stocks in this case bringing them back down to 60%, and buy more of the assets that have lagged, the bonds bringing them back up to 40%. This systematically locks in some gains and buys assets when they are relatively cheaper.
So it enforces a sell high, buy low discipline automatically. Does it increase returns?
Not necessarily. Sometimes it can slightly drag returns if the winning asset class continues to run, but its primary benefit is risk reduction. Studies show that regularly rebalanced portfolios experience significantly smaller drawdowns during market crashes compared to unbalanced portfolios. So rebalancing is about staying aligned with your risk tolerance.
Okay, rebalancing for risk control. What's reason number 2 to sell?
A fundamental change in your belief about an asset. This requires careful thought, not just reacting to price movements. If the reason you initially bought an investment, say, a specific company's competitive advantage or a sector's growth prospects, has genuinely structurally changed for the worse based on new information and analysis, then it might be time to sell.
So based on a change in the underlying story or facts, not just because the price dropped or you got scared.
Exactly. Selling based on fear or short-term price action is market timing, which we want to avoid. Selling based on a well-reasoned fundamental reassessment is prudent portfolio management.
Got it. And the third and probably most common reason to sell?
Funding the life you need. Using your investments to pay for important life goals. Retirement income, obviously, but maybe also a house down payment if you follow the time horizon rules.
Yeah.
Paying for education, starting a business, handling a major emergency.
So using the money you've accumulated.
Right. But there's a priority order suggested here. Fund the life you need before you risk capital for the life you merely want.
Meaning?
Prioritize safety and security first. Make sure your emergency fund is solid. Fund essential education goals. Maybe pay down high-interest debt or even pay off the mortgage if that provides peace of mind. Only after those foundational needs are met should you start selling investments for more aspirational wants, like a vacation home or a fancy car. Build the foundation before the frills.
And when selling, especially if it's a concentrated position that has done really well, the advice is still sell slowly.
Yes, for a couple reasons. First, taxes. Selling a large appreciated position all at once can trigger a significant capital gains tax bill. Spreading the sales over multiple tax years can help manage that impact.
Okay, tax management. What's the other reason?
Regret minimization. If you sell your entire winning stock position and then it continues to skyrocket, you'll likely feel intense regret. Selling gradually, maybe selling a third now, a third next year, etc., locks in some gains but keeps some skin in the game. reducing the potential for seller's remorse if it keeps going up. Buy quickly, sell slowly.
Okay, clear guidelines on selling. Now, let's tackle a specific investment vehicle, the 401k. There's always the debate. Roth versus traditional. How do the sources simplify this?
The core principle is simple. Pay taxes when your effective tax rate is lowest.
Lowest now or lowest in retirement?
Exactly. If you expect your tax rate to be higher in retirement than it is now, maybe you're early in your career, then the Roth 401k makes sense. You pay taxes now on the contributions at your current lower rate, and all qualified withdrawals in retirement are tax-free.
Okay, Roth if you expect higher taxes later.
If you expect your tax rate to be lower in retirement than it is now, maybe you're in your peak earning years, then the traditional 401k makes more sense. You get a tax deduction now on the contributions at your current higher rate. Your money grows tax deferred, and you pay income taxes on withdrawals in retirement, hopefully at that lower future rate.
Pay taxes when the rate is lowest. Seems straightforward. Does one offer more flexibility?
The traditional 401k arguably offers a bit more optionality. Because the money hasn't been taxed yet, you have the option later on, perhaps during years where your income is temporarily low, like between jobs or early retirement before Social Security kicks in, to strategically convert portions of the traditional 401k to a Roth IRA, paying taxes at that low rate. Roth contributions are already taxed, so you don't have that conversion flexibility.
Okay. Traditional offers some conversion potential. Now here comes the really controversial part from the sources. The idea that you probably shouldn't max out your 401k, at least beyond getting the full employer match. Why on earth not? Standard advice is always max it out.
It's a provocative take, for sure. The argument boils down to a trade-off between the tax advantage and liquidity.
Liquidity meaning access to your money before retirement age.
Exactly. The question is, how much is that tax advantage actually worth compared to locking up your money until age 59 and a half?
Okay. How much is the tax benefit worth, typically?
The analysis suggests that the long-term benefit of tax advantage growth in a 401k, compared to just investing in a regular taxable brokerage account, assuming you manage it tax efficiently, is surprisingly small, maybe around 0.38% per year in extra return on average.
Less than 0.5% per year? That doesn't sound like much.
It's not huge. And then you have to consider the fees inside many 401k plans. The average 401k plan fee is estimated to be around 0.45% per year.
Wait, so the average fee is higher than the average tax benefit?
In many cases, yes. The fees can easily eat up or even exceed the marginal tax advantage you're getting from the 401k structure compared to a low-cost taxable account.
So the argument is that this potentially tiny or even negative after fees tax premium might not be worth sacrificing liquidity for decades, especially when you're young.
That's the core argument. For a younger person, having access to their capital, that liquidity, might be incredibly valuable for major life goals that happen before age 59 and a half. Things like buying a house, starting a business, funding education, handling emergencies. Locking up too much money in a 401k beyond the employer match, which free money, always take that, might restrict your ability to pursue these high leverage opportunities when they arise.
So get the match, then maybe prioritize saving in a taxable account or a Roth IRA, which allows withdrawing contributions tax penalty free for greater flexibility before going back to max out the 401k.
That's the controversial suggestion. Prioritize liquidity and flexibility, especially early on, unless you're in a very high tax bracket where the immediate deduction from traditional contributions is overwhelmingly valuable, or your 401k plan has exceptionally low fees. It challenges the default max it out advice.
Definitely food for thought. Okay, let's shift to a more philosophical point near the end. We strive to build wealth, but the sources suggest you'll never actually feel rich. Why not?
Because wealth is fundamentally a relative game. We don't judge our wealth in absolute terms. We judge it relative to others around us, or relative to our past selves, or relative to our aspirations.
There's always someone richer to compare yourself to.
Always, unless you're literally the richest person on the planet at that moment. The example given is Jack Whittaker, the guy who won a massive $315 million Powerball jackpot, took home $113 million after taxes.
Okay, definitely rich by any objective standard.
You'd think. But even years later, when he reportedly still had $17 million left, he was apparently still playing the lottery regularly. He didn't feel rich enough, perhaps because he was comparing himself to the truly mega rich, or maybe the burdens of the wealth changed his perspective. The goalpost always seems to move.
And this relativity is even baked into our social networks, right? The friendship paradox.
Exactly. The friendship paradox is the statistical observation that, on average, your friends have more friends than you do.
Why?
because people who are very popular, have lots of friends, are by definition more likely to show up in many different people's friend circles, pulling up the average.
Okay, makes sense. How does that apply to wealth?
The same logic applies. Most people tend to feel less wealthy than their peer group because wealthier individuals, who often associate with other wealthy individuals in professional or social settings, are overrepresented in our comparison set. We are more likely to encounter and compare ourselves to people doing better financially than those doing worse.
So our perception is skewed upwards by the visibility of wealth around us.
Right. It leads to a situation where almost everyone feels average or below average financially compared to their immediate circle. Research shows even households in the 90th percentile of income distribution often underestimate how well off they are compared to the general population. They look at the 95th or 99th percentile and feel relatively poor.
So the feeling of being rich is a constantly moving target, an illusion based on comparison.
Pretty much. Chasing that feeling is likely futile.
If we accept that, and accept that money's primary purpose is to solve problems and provide options, what should be our ultimate focus, if not the feeling of being rich?
The focus shifts to the one truly finite, non-renewable resource we all possess: time.
Time, the ultimate asset.
The sources use a powerful thought experiment, often attributed to Peter Attia. Imagine Warren Buffett back when he was, say, 87 years old. Would you trade places with him? You get his entire vast fortune, billions of dollars. But you also have to be 87 years old with his health and remaining lifespan.
Would I take the trade? Billions of dollars, but only maybe a few years left in potentially declining health.
Most young, healthy people, when honestly considering it, say no. They wouldn't trade their time, their youth, their health, even for Buffett's entire fortune.
That really puts the value of time in perspective, doesn't it? Money can't buy more time.
It's the only asset you can't acquire more of. Time is what allows compounding to work its magic. Time is what allows for perseverance, for learning, for building skills. Think about that story of Dasrath Manji in India.
The mountain man.
Yeah. His wife died because she couldn't get medical care in time, needing to travel around a large mountain. So he spent 22 years, single-handedly, carving a path through the mountain with just a hammer and chisel, shortening the distance dramatically for his whole village. He traded decades of his time for a lasting legacy. Time enables incredible feats.
And from a financial perspective, time is most valuable when you're young, right? In terms of career growth.
Absolutely. Your income potential typically grows most rapidly during your first decade or so in the workforce, maybe ages 25 to 35. That's when you're learning the most, getting promotions, building your skills, optimizing your career and income during that early period. Leveraging your time effectively then has a far greater impact on your lifetime wealth than agonizing over whether your initial $5,000 investment portfolio has the absolute perfect asset allocation. Focus on maximizing the value of your time, especially when young.
Okay, so let's quickly recap the core JKB rules, the key takeaways for listeners trying to win this financial game, maximizing their odds, regardless of what the future holds.
Rule 1. Know where your leverage is. Focus on saving when your assets are small. Shift focus to investing as your assets grow.
Rule 2. Prioritize growing your income, your human capital. Use tools like the 2X rule to spend guilt-free along the way.
Rule 3. Control lifestyle creep. Save 50% of your future raises and bonuses.
Rule 4. Keep investing simple and rational. Avoid individual stocks. The odds and emotional costs are too high. Stick to diversified, low-cost funds.
Rule 5. Buy quickly. Sell slowly. Get your money invested as soon as you can, as often as you can. Don't try to time the market. When you do sell, do it deliberately and gradually.
And the final, overarching principle.
Rule 6. Recognize that time is your most important, most finite asset. Protect it, invest it wisely, especially in your skills and career when you're young. It's worth far more than any dollar amount.
So we started this deep dive talking about building wealth. But the data, and maybe wisdom, suggests you might never feel rich because wealth is relative. Time, however, is absolute. You can't get more of it.
Which leads us to the final provocative thought for you, the listener. If you accept that you can likely always figure out ways to earn more money over time, but you can never buy more time, what's the single most important action you can take today related to your career, your skills, your human capital? What action will best maximize the long-term value of that truly irreplaceable asset, your time?
Something to think about.
Yeah.
Until the next deep dive.